Listen carefully, because what I am about to explain is not a short-term fluctuation, and it is not a routine market development. You are looking at the early stages of a structural shift that most participants will not recognize until it is already well underway. And if you are holding 500 ounces of silver, this is no longer a passive position. It is a strategic exposure to something much larger than price movement alone. I want you to understand the environment we are entering, because right now, most investors are focused on the surface. They are watching headlines. They are reacting to central bank statements. They are tracking equity performance as if that alone defines stability. But the real changes never begin where everyone is looking. They begin beneath it, quietly, gradually, and then all at once. This is not speculation. This is how every major transition unfolds. At the same time, the underlying structure of supply has not kept pace with what is coming. Silver production has not accelerated in a meaningful way. Discoveries remain limited, extraction costs continue rising, and the reality is, mining is not a system that responds quickly. It is slow, constrained, and increasingly complex. Regulatory pressure, environmental restrictions, and geopolitical considerations are all limiting expansion. This creates a condition that can be ignored temporarily, but never permanently. Because when demand continues to build while supply remains restricted, pressure accumulates. And pressure, when it reaches a certain point, does not release gradually. It forces repricing. Now, this is where most people lose clarity. They expect confirmation. They expect a clean signal. They want a smooth upward trend that validates their decisions before they act. But real transitions do not provide that comfort. They are volatile. They are uncertain. They create doubt at precisely the moment when conviction is required. Silver does not move in a way that reassures you at the beginning. It moves in a way that challenges you. Sharp advances followed by sudden pullbacks, conflicting narratives, analysts disagreeing. One moment it appears to break out, the next it reverses. And that confusion is not accidental, it is part of the transition. It filters out weak conviction before the real move begins. You need to separate noise from signal. The noise is the daily fluctuation, the headlines, the short-term opinions. The signal is behavioral change, and that is what is starting to emerge. Silver is no longer behaving purely as an industrial commodity. It is beginning to reflect characteristics of a monetary asset again. That distinction is critical. Industrial assets respond to growth cycles. Monetary assets respond to declining confidence. And what we are starting to see is not just a shift in demand, but a shift in trust across parts of the financial system. Most people are not looking there. They are focused on visible indicators. But the foundation of the system is where the real stress is forming. For decades, the bond market represented stability. It was the anchor. It provided predictability. But that stability was built on a specific condition: low interest rates. Cheap money allowed governments to expand deficits, corporations to refinance endlessly, and consumers to sustain spending through credit. Debt grew because it was manageable. But debt behaves differently when conditions change. When interest rates rise, what once appeared stable begins to reveal underlying fragility. Servicing costs increase. Refinancing becomes more difficult. Margins tighten. And slowly, the system begins to feel pressure at every level. This is not a theory. This is the mechanical reality of leverage. And when that pressure begins to spread, capital does not wait for headlines. It starts adjusting quietly. Small reallocations at first, then larger ones, then institutional positioning that does not announce itself but leaves a footprint in market behavior. By the time the majority becomes aware, the transition is already in progress. This is exactly where silver becomes important again, because silver operates at the intersection of two forces that are both strengthening. On one side, it is a monetary asset. When confidence weakens, demand for monetary protection increases. On the other side, it is an industrial necessity deeply embedded in the infrastructure of modern economies. Very few assets exist in both of these dimensions simultaneously. Silver does, And because the market itself is relatively small compared to the scale of global capital, it does not require a massive shift to create a significant impact. Even a modest reallocation can move the market in a disproportionate way. This is why silver does not respond slowly when conditions align. It reprices decisively. Now I want you to think about what that means for your position. If you are holding 500 ounces of silver, you are not just holding a metal. You are holding exposure to a system that is beginning to change direction. Ownership in this environment is no longer passive. It becomes intentional. And when ownership becomes intentional, the entire dynamic shifts. It is no longer about waiting. It is about understanding. Because what we are discussing here is not just about silver. It is about the structure that assigns value to every financial asset. It is about a system built on expansion, now encountering limits. You need to understand what happens when that system begins to strain. Modern financial systems are built on one central mechanism: credit expansion. Governments issue debt to fund operations. Corporations rely on borrowing to grow and sustain margins. Consumers use credit to maintain purchasing power. This entire structure functions efficiently under one condition: liquidity must remain abundant and borrowing costs must remain manageable. For a long time, that condition held. Interest rates remained low. Capital was accessible. Risk was suppressed. And as a result, the system expanded. Debt levels increased across every layer, but it did not appear dangerous because servicing that debt was relatively easy. But no system built on continuous expansion can operate indefinitely without encountering limits. At a certain point, the scale of debt itself becomes the constraint, because once interest rates begin to rise, the cost of maintaining that system increases rapidly. Governments face higher debt servicing obligations. Corporations lose flexibility, consumers reduce spending, and what once appeared stable begins to show signs of strain. This is where we are now. Global debt remains elevated. Fiscal deficits continue expanding. Central banks are no longer operating in a simple environment. They are forced into a position where every decision introduces consequences. Tightening policy may control inflation, but it also increases stress across a highly leveraged system. Loosening policy may stabilize markets temporarily, but it weakens currencies and risks accelerating inflation. These objectives do not align, and when policy cannot resolve competing pressures cleanly, confidence begins to erode, not all at once, not in a dramatic collapse, but gradually behavior changes. Investors begin to question assumptions that once felt certain. Institutions begin to reconsider how capital is allocated. And when that process begins, it rarely reverses quickly. This is the stage where positioning matters more than prediction, because once confidence begins to weaken, the search for alternatives accelerates. Capital does not disappear. It moves. It rotates. It looks for assets that are less dependent on policy credibility and more grounded in structural value. Silver is directly within that path. Unlike financial instruments, silver does not rely on central bank balance sheets. It does not depend on government promises. Its value is not derived from policy credibility. It exists independently of the system that is now under pressure. And that independence becomes increasingly important as confidence begins to shift. But silver's role does not stop there. It is not only a defensive asset. It is also deeply integrated into the industrial framework of the modern economy. And this dual function creates a powerful dynamic. Think about the direction of global infrastructure. Energy systems are transitioning. Electrification is expanding. Renewable technologies are scaling. Digital infrastructure continues to grow. Each of these developments requires materials with high conductivity and reliability. Silver is one of the most effective conductors available. It is essential in solar energy systems. It is embedded in electric vehicles. It is used in advanced electronics, telecommunications networks, data centers, and medical technologies. These are not optional applications. They are foundational to the next phase of economic development. This is not a temporary demand cycle. It is a structural transformation. And that matters because industrial demand for silver is not driven by sentiment, it is driven by necessity. At the same time, supply remains constrained in ways that are often underestimated. Mining is not a flexible process. It cannot respond quickly to changes in demand. New projects take years to develop. Regulatory approvals introduce delays. Financing conditions create limitations. Operational risks add uncertainty. Environmental restrictions further slow expansion. And there is another critical factor. A large portion of global silver production is not primary. It is produced as a byproduct of mining other metals. This means supply does not respond directly to silver prices. Even if demand increases significantly, your production cannot scale at the same pace. This creates an imbalance, and markets operating under sustained imbalance do not remain stable. They eventually adjust, not gradually, not smoothly, but forcefully. Now consider the scale difference between silver and the broader financial system. Global equity markets represent tens of trillions of dollars. Bond markets represent even more. Institutional capital operates at enormous scale, constantly reallocating in response to changing conditions. The silver market, by comparison, is extremely small. This creates a critical dynamic. It does not require a massive shift in global consensus to move silver significantly. It requires only a relatively small portion of capital to redirect its attention. And attention is beginning to shift. This is why silver historically moves in sudden phases. It remains quiet for extended periods while underlying conditions build. Then, when capital begins to flow in, the adjustment is rapid. Investors who wait for confirmation often find themselves reacting too late. They enter after momentum has already developed. They respond instead of anticipate, and by the time the move becomes obvious, the opportunity has already changed. This is not about identifying the exact moment of transition. It is about understanding the structure that leads to that moment. If you are holding 500 ounces of silver, you need to recognize what that represents. You are not holding a passive asset. You are holding exposure to a system undergoing pressure, imbalance, and eventual adjustment. And those adjustments are never linear. They are volatile. You have to create uncertainty. They force decisions under conditions that are uncomfortable. But that discomfort is not a sign that something is wrong. It is a sign that something is changing. Volatility is often misunderstood. Periods of calm reflect stability or complacency. Periods of volatility reflect transition. When markets move from one equilibrium to another, they do not move in straight lines. They move in waves. During those waves, ownership changes. Short-term participants exit positions. Long-term holders accumulate. Institutions build exposure gradually. And over time, the character of the market transforms. Silver has followed this pattern repeatedly throughout history. Long periods of neglect followed by renewed attention, followed by rapid repricing. And each time, the explanation becomes clear only after the move has already occurred. But the conditions that created those moves were visible in advance. They were simply ignored. And that is exactly where we are again. The same conditions are forming, not in theory, but in real time. Debt levels remain elevated across the global system. Fiscal deficits continue expanding without meaningful restraint. Monetary policy is constrained by competing objectives that cannot be resolved cleanly. Inflation pressures persist beneath the surface, even when temporarily moderated. Each of these forces is pushing investors toward a single conclusion, whether they recognize it yet or not. The existing framework is under strain. For years, markets operated within a structure that felt predictable. Governments issued debt. Central banks intervened when necessary. Bonds provided safety. Equities delivered growth. And precious metals remained in the background, rarely required outside of extreme conditions. That framework worked because confidence held. But confidence is not permanent. It is conditional. And when the conditions supporting that confidence begin to weaken, behavior changes. Not suddenly, not in a way that triggers immediate panic, but gradually, quietly, investors begin reassessing assumptions that once felt unquestionable. They begin asking different questions. What happens if inflation does not return to target levels in a stable way? What happens if interest rates cannot fall without creating instability elsewhere? What happens if debt continues expanding faster than the system can absorb? These are not abstract concerns. These are structural realities. And once investors begin to recognize those realities, positioning begins to change, not through dramatic announcements, but through steady reallocation. Institutional capital does not wait for consensus. It moves ahead of it. This is how every major transition unfolds. First, the early signals appear, then a small group responds. Then larger players begin adjusting without drawing attention. And only later does the broader market recognize what has already begun. By that point, repricing is no longer a possibility. It is already happening. Silver sits directly in that path. It is not just a commodity reacting to industrial demand. It is not just a hedge used in moments of uncertainty. It is a reflection of deeper forces within the system. It responds to shifts in confidence, to pressure within monetary structures, to changes in how capital is allocated during periods of transition. It is a signal. And signals like this do not emerge randomly. They appear when underlying conditions begin to align. Now consider the psychology of market participants during these phases. Most investors do not act early. They wait for clarity. They wait for confirmation. They rely on consensus to validate their decisions. But by the time consensus forms, the opportunity has already evolved. Early stages always feel uncertain. They lack clear direction. They produce conflicting narratives. They create discomfort. And that discomfort is exactly why most participants hesitate. But hesitation carries a cost, because once attention returns to a previously neglected asset, capital follows. And when capital flows into a market with constrained supply, price movement accelerates. Silver does not move in a smooth trend. It moves in phases. Long periods of quiet accumulation where positioning builds beneath the surface. Then sudden bursts of activity where price begins to respond. Then volatility that tests conviction. And finally, continuation that surprises those who waited too long. This pattern has repeated across cycles. Neglect, accumulation, recognition, repricing. What changes each time is not the sequence but the scale. And the scale today is shaped by a financial system that is larger, more interconnected, and more dependent on continuous expansion than at any point in modern history. That dependence matters, because when a system relies on constant growth to maintain stability, any disruption creates disproportionate effects. And when those effects begin to spread, capital does not remain static. It moves toward assets that are less exposed to systemic risk. This is why silver becomes relevant again, not because of speculation, not because of short-term narratives, but because of its structural position within a changing system. And this is where most investors make their mistake. They are not absent at the beginning. They see the early signals. They understand the argument. But when volatility appears, when uncertainty increases, they lose conviction. They exit positions before the cycle fully develops. That is how opportunity transfers, from those who react emotionally to those who understand structurally. And that process repeats in every cycle. Now we are entering another one. The signals are forming. The pressures are building. The environment is shifting. Not dramatically on the surface yet, but meaningfully beneath it. Silver is responding to those changes, not in a way that immediately captures attention, but in a way that reflects underlying transition. And that is what you need to focus on. This is not about predicting an exact price. It is not about chasing short-term movement. It is about recognizing direction, because direction, once established, tends to persist longer than most expect. The real question is not whether this shift will occur. The real question is whether you understand it early enough to recognize what your position represents. Because if you are holding 500 ounces of silver, you are not simply holding an asset, you are holding exposure to a system in transition. And transitions do not wait for consensus. They unfold regardless of whether you are prepared. They create volatility. They create doubt. They test conviction. but they also create opportunity for those who understand what is happening before it becomes obvious. History has shown this again and again. These periods never end quietly. They resolve through adjustment, through repricing, through a redefinition of value across the system. And when that process begins, it does not reverse easily. So you need to decide how you view your position. Is it something you hold casually, you reacting to short-term movement? Or is it something you understand within the context of a larger structural shift? Because that distinction determines how you respond when volatility increases. It determines whether you hesitate or remain positioned. It determines whether you react or anticipate. And in cycles like this, that difference matters more than anything else. The shift is not approaching. It is already beginning.